Hi everyone, I'm Carl. Welcome back to the Renko Trading channel. Before we start, this content is for educational and experimental purposes only. It is not financial advice. Always do your own research before making any investment decisions. Before we get started, I want to set the stage for what this video is and what it is not. What you are about to see is a backtest illustration, not a ready-to-trade system. This is simply how I backtest Renko charts across different time frames to see how the same idea behaves under different conditions. The strategy used in this example is intentionally very simple. We are not using indicators, support and resistance, trend lines, or even a defined stop loss. It is a bare minimum framework designed to isolate price behavior and trend structure on Renko charts. The goal here is education. It is to show the process of testing, comparing, and thinking through strategy behavior, not to present something you can immediately trade live. If you decide to take ideas from this, you still need to account for real-world factors like risk management, position sizing, and execution. With that context in mind, let us walk through the test. In this video, I want to walk through a very simple Renko trading strategy and show how it performs on two different time frames. This is a long-only strategy. We only take buy trades. The concept is straightforward. We are simply following the trend using higher highs and higher lows. After a confirmed reversal, we wait for price to break and close above the first swing high, and that breakout becomes our entry. Once we are in the trade, we do nothing as long as the trend continues to make higher highs and higher lows. We hold the position and let the trend work. The exit rule is just as simple. When price closes below the most recent swing low, that is our sell signal. There are no indicators in this strategy. We are not using trend lines, moving averages, support and resistance, or anything else. This is purely price action based on Renko structure. First, we will apply this strategy to the euro on the daily chart. Then, without changing any rules, we will switch to the 4-hour chart and compare the results. After that, you can decide how you might add additional filters or rules to fine-tune the strategy, improve consistency, or reduce drawdowns. But for this video, I want to show how far a simple higher high, higher low breakout approach can take us on its own. Let us start with the euro on the daily chart. We are using a traditional Renko setup with a fixed brick size of 50 pips. Every brick represents the same price movement, regardless of time. The rules are very simple. After a confirmed reversal, we enter on the breakout of the most recent swing high. We stay in the trade as long as price continues to form higher highs and higher lows. We exit only when price closes below the most recent swing low. Now let us go back to late September 2022. At that time, the euro formed a bottom near 0.96. After that low, the first swing high forms at 0.995. Price pulls back to around 0.97, confirming a swing low. We now wait for a breakout above 0.995. Because Renko is based on closing prices, the breakout occurs on October 26, when price closes at 1.005. That becomes our entry. Price briefly pulls back, but it does not close below the swing low. Instead, it forms a higher low and continues upward. This trend runs all the way up to around 1.12. Price then pulls back to 1.08. That is still higher than the previous low near 1.07, so we remain in the trade. However, 1.08 now becomes our new reference swing low. Eventually, price closes one brick below 1.08 at 1.075. That gives us our exit. So we enter at 1.005 and exit at 1.075 for a gain of roughly 700 pips. Now we move to the next setup. The new swing high forms near 1.095. We wait for another breakout. On October 21st, price closes at 1.1, triggering a new entry. Unfortunately, price reverses and eventually closes below the swing low near 1.08. We exit around 1.075. This trade results in a loss of about 250 pips. We continue monitoring the chart. A new low forms around 1.07, followed by a swing high near 1.09. We wait patiently for the breakout. In early August, price finally closes at 1.095, giving us another entry. This move is short-lived. Price soon closes below the swing low near 1.105, giving us a small gain of about 50 pips. Price then drops again to around 1.025 and begins climbing. A swing high forms near 1.045, with a swing low around 1.03. When price closes at 1.05, we enter again. This time the trend is much stronger. Price rallies all the way up toward 1.18, before pulling back to a swing low near 1.16. When price closes below that level at 1.155, we exit. So for this final daily trade, we captured roughly 1050 pips. From September 2022 through July 2025, the euro itself moved roughly 2,200 pips from low to high. Using this very simple Renko strategy on the daily chart, we captured about 1,600 pips of that move. That is without using any indicators, trend lines, support and resistance, or additional filters. We only followed higher highs and higher lows, entered on the breakout of the first swing high, and exited when price closed below the most recent swing low. We did not catch the exact bottom, and we did not exit at the exact top. But we were able to capture the core of the trend, while avoiding the need to predict anything. That means we captured roughly 73% of the entire move, without trying to pick the exact bottom or top. So that is how the strategy performs on the daily chart. Now let us take this exact same setup and apply it to the euro on the 4-hour chart. The rules do not change at all. Only the time frame changes. This naturally creates more swings, more trades, and more exits, and that is what we want to study. We will start again from the same September 2022 low near 0.96. The first swing high forms near 0.995. On October 26th, price closes at 1 even, giving us our first 4-hour entry. Price retraces slightly but holds a higher low. The trend continues upward to around 1.105 and later forms a swing low near 1.095. On May 12th, price closes below that swing low at 1.09. That gives us our exit. From 1 even to 1.09, this trade gains about 900 pips. Next, price forms a swing low near 1.065 and a swing high around 1.095. On July 10th, price closes at 1.1, triggering another entry. The market pushes higher to around 1.125, then reverses and closes below the swing low near 1.085 on August 24th. We exit at 1.08 for a loss of about 200 pips. A new swing low forms near 1.05, followed by a swing high near 1.065. On November 3rd, price closes at 1.07 and we enter again. Price moves higher, then eventually closes below the swing low near 1.09 at 1.085. That gives us a gain of roughly 150 pips. We continue forward. Another swing low forms near 1.065 with a swing high around 1.09. When price closes above, we enter at 1.095. Price later breaks below the swing low near 1.105 and we exit at 1.1. This trade captures about 50 pips. Price then drops to around 1.02 and forms a swing high near 1.05. On March 4th, price closes at 1.06, giving us another entry. This move rallies strongly to around 1.14 before eventually breaking below the swing low near 1.13. We exit at 1.125, capturing roughly 650 pips. Next, price forms a swing low near 1.11 and a swing high around 1.14. On the breakout, we enter at 1.145. Price reaches toward 1.18 before reversing and closing below the swing low near 1.16. We exit at 1.155 for a gain of about 100 pips. Finally, price forms a swing low near 1.145 and a swing high near 1.17. On September 8th, price breaks above and we enter at 1.175. This move fails. Price eventually closes below the swing low near 1.16 on October 31st. We exit at 1.155, resulting in a loss of about 200 pips. Let us summarize the results from the 4-hour chart. From September 2022 through July 2025, the euro moved roughly 2,200 pips from low to high. Using the exact same Renko strategy on the 4-hour chart, we captured approximately 1450 pips. That means this strategy captured about 66% of the entire move on the 4-hour time frame. Again, this was done without using any indicators, trend lines, support and resistance, or additional filters. We simply followed higher highs and higher lows, entered on breakouts, and exited when price closed below the most recent swing low. Compared to the daily chart, the 4-hour chart produced more trades, more whipsaws, and smaller individual moves, but it still managed to capture a large portion of the overall trend. What this comparison shows is not that one time frame is better than the other. The daily chart produces fewer trades, longer holding periods, and larger individual swings. The 4-hour chart produces more trades, more noise, and more frequent exits, but it still captures the major trend. And this is where personal risk tolerance really starts to matter. On the daily chart, you might see a maximum drawdown of 300 pips. That is a meaningful move. Whether that drawdown feels acceptable or stressful depends entirely on your account size and your position size. 300 pips means very different things to different traders. For one person, it might be manageable. For another, it could take a large chunk out of their account. That is why position sizing is critical. You need to size your trades in a way that allows you to sit through larger drawdowns without damaging your overall account balance or your decision-making. As you move from a daily chart to a 4-hour chart, or even a 1-hour chart, you are not just changing time frames. You are changing the risk profile of the strategy. So your time frame, your account size, your position size, and your personal risk tolerance all need to work together as part of a complete trading plan. In this illustration, we intentionally used the simplest possible strategy. We only traded in the direction of the trend. We only used higher highs and higher lows. We only entered on breakouts. We did not use indicators, trend lines, support and resistance, or even a defined stop loss. On paper, this looks clean and straightforward. In real life, trading is rarely that simple. That is why backtesting is only the starting point. When you move from charts to live trading, you need to account for real-world conditions. Things like where you place your stop loss, how you manage risk, and how you handle drawdowns all become extremely important. So think of this as a framework, not a finished system. Once you understand how a simple trend-following structure behaves, you can begin adding rules and filters that fit your own goals, risk tolerance, and trading style. That's a wrap on today's breakdown. Thanks so much for watching. If you found this helpful, give it a like and hit subscribe for more Renko trading insights. Don't forget the bell icon, and I'll see you in the next one.